Welcome, Enigma traders, to this webinar on 2nd of April 2020. This is going to be looking at stocks in particular, and also looking at stocks for longer term holders. Okay, so it's just another string to add to the bow with the service that we provide here at Enigma Strategy for you to look at. You can trade these on shorter term, these stocks I'm showing, but realistically, these are for longer term holds, as you would see as I go through the charts. And what we've seen with coronavirus, okay, it does give opportunities for long-term investors to actually jump into the market. And of course, you can actually, I say longer term, you can still use CFDs and options for taking up positions in these stocks. I would say probably more. These are going to be more for CFD purchases, or even just buying the actual equity outright. Okay, so let's start by going to the charts. So this is webinar number 11. Please note this is trading any sort of derivative, okay? If you are using derivatives to trade any of these stocks that I'm about to show you, okay, is extremely risky and can cause substantial financial loss. Derivative trading is not suitable for everyone. Please only use risk capital you can afford to lose. Make sure you put your stops in, and know the risk that you're taking on board. If you don't know what you're doing, and you need help with trading these rough and tumble markets that we're seeing at the moment, then please come down to our website, www.enigmastrategy.com. Okay, so we've got the chart here on the US dollar. As we know from the normal financial webinars that we do, we've been keeping a look on the dollar itself. Dollar has risen, and we're up at the top of the channel that we've been trading in for the last couple of years. Okay, and I said to you yesterday when we did our webinar that we'll be looking for the dollar to come back up to the top of the channel to test up to that level, which is what it's doing today. Strong day in the dollar, but we've also seen a strong day across the it's an up day. When you see 1.8% on the S&P, I remember saying that used to be a strong day. Today, it's just obviously just an exchange of a couple of contracts, right? So it's an up day in the market, up day in the dollar, up day pretty much everything, including we haven't seen some sort of bounce with oil. But anyway, this is not to do with the general financial markets. We're going to be looking at a series of stocks here, okay, in the US. For a potential view of picking up these stocks, these are stocks if they are suitable for you, okay? And I'll explain to you where I would be, in my opinion, where I'd be looking to buy into them, and where I feel these stocks will be moving to in terms of their share price rise. Okay, so first one on the list is Facebook. Okay. In fact, the next couple of them are all FANG stocks, okay, technology stocks that are deemed to do quite well out of the back of this coronavirus. It's not going to take much for these guys to pick up where they left off before the light switch was turned off. Okay, so Facebook, before the pandemic came in, okay, we was trading up at around about above the 200 level. Okay, we saw Facebook crash below the 200-day moving average, and it's basically on the lows that we saw all the way down on the 18th of March, which was about 140. Okay, this is a level, and we're going to go from daily to weekly right now. Okay, this was a strong level within Facebook itself. Okay, it was a level where it tried to break through back in March 2017. Came back down to this in those in the last quarter of 2018. Okay, got a flush below 140 back in December 2018, at which point it then decided that it was going to have a run all the way back up to its highs, okay, that it had seen all the way back here in July 2018, okay, and as far as the beginning of the year, okay, just blipped above those highs, okay. So it has a tendency to actually come back down, okay, and test the 140 level. 140 level seems to be a very good level for Facebook. Last time it actually came down Facebook, it actually came down to the 200-day moving average, which of course is this blue line here, and this was a level that supported the market. When we look at where we are with Facebook at the moment, we're again we're trading below the 200-day moving average, okay, and we're trading off that 140 level, okay. But as you may well know from my general financial market outlook, okay, that I am expecting to see potentially the market to come back down and come down to test those lows again, okay. Now, what I would be looking for is any sort of move down below, I say down to 120 to 110 on Facebook would be a great position to pick up Facebook for a long-term hold. From there, it would flush out all the stocks that are sitting from December 2018, okay? And that would give an excellent opportunity for Facebook then to springboard all the way back up, okay? And we would be looking then to move all the way back up to 220. So that's nearly, that's about an 80% rise there that we'd be looking. So it would take about 12 months potentially to get up there, okay? But yeah, I would be looking for a purchase of Facebook between 120 and 110. If we could get down there, I think it would be a great place to pick up Facebook. Next, we'll look at Apple. Again, this is on the weekly, okay? Here is our bearish channel that we spoke about on the general financial webinars that we've been doing, okay? Here's the 200 weekly moving average, okay, coming down the bottom here. Apple doesn't tend to actually touch this moving average too much, okay? In fact, it respects this moving average very well. Let me just open this back for you. You can see how well this respects this moving average. I'm now going, here we go, look. I mean, it's even getting too difficult to see, but as you can see, look, this chart's going all the way back to 2004. Breaks away from the moving average, tests it round in 2008, 2009 during the financial crash, okay? Shot away from it, come back down, test the level again back in June 2013, okay? Shot away from it, come back down and test around the midpoint of 2016, okay? Took off again from it, okay? Come all the way back down, tested it at Christmas 2018, okay? It's taken off from it again. And if we was to come back down to it again, okay, and as I say, that's 1, 2, 3, 4, and I suppose it's basically been listed on there 5 times over the last 16 years that it's touched this moving average, okay. So a very well respected moving average, okay. That would be, at the moment, that would give us down about 180, okay, if the market was to fall there. How it's actually expanded out, I would be looking to necessarily get in that late here with Apple, okay. We could very much get down to that level, and there's no reason for it to not get to 180. But I think actually for Apple, a good buy would be anything, I would say, from 200 down to about 190, or even if you've got the appetite to actually wait till you get down to that 200-day moving average. Great opportunity to buy a decent company, okay, for the long term. Trading at 240 at the moment, so obviously I would have to have a bit of movement to the downside to actually get to our sort of entry target. But as I say, I would be looking 200 to 190 as a perfect entry level, okay, or even straight off the 200-day moving average, which the last time we touched it and we just kissed it was back on New Year's Eve in 2018. So here is our long-term strategy with Apple. Next is Amazon. Amazon's obviously been doing, early indication is Amazon's doing quite well out of the coronavirus situation. Obviously, you need products, you can't go to the shops. So what do? You actually call Amazon, message them, get Alexa to make a an order for you, okay, and they obviously just gets delivered straight to your door. You don't have to go out or mingle with anyone or actually have any risk of catching the coronavirus. Amazon's there to save the day for you. And also with that as well, you can stay at home and also watch Amazon TV, Amazon Prime. So Amazon are doing quite well potentially out of this situation. Okay, so a good company that to own as we would emerge out of this coronavirus. I'm still on the weekly here. We're trading at 1914 at the moment. We got the 200 weekly moving average currently trading at just shy of 1400 here. Okay, this stock has been relatively strong since the sell-off, okay, and has come down to a low just to test the lower Bollinger Band and the weekly, and then obviously it's taken all the way back up to the midpoint, the 18-day move, 18 weekly moving average there. Okay, I would be looking as a good place to actually start pick up Amazon would be for this to come down and test this 200 weekly moving average. Okay, so that would potentially be around about this 1425 level. Okay, would be a good place to pick up, or wherever that moving average moves up to. Okay, once we get the share price down to that, if it does, okay, that will be a place that I would think would be a good place to pick up Amazon for the long term. Hasn't shown any weakness to actually get us downstairs yet, but as I say, if we start to see some big selling coming into the market, okay, then that could be an opportunity for investors to pick up Amazon back down at the 1400 level. As I say, that would also be a level of support that we last saw back in Christmas 2018. Okay, so one to look out for there for Amazon. Netflix is also doing well from the coronavirus situation. Obviously, everyone's at home, everyone's watching Netflix, and as such, okay, we're trading basically at the top of the trading range it's been in since summer of 2018. Okay, so this trading range, realistically, I suppose we actually broke into it 2 years ago. Okay, so this trading range has been developing over the last 2 years, and we're at the top. Okay, so typically what we do find is that we get to the top of the trading range, down up at this 380 level. Okay, and we crash down towards the bottom of the range. So here we are, July 2018, down to the midpoint, back up to 380 again, all the way back down to the bottom of the trading range, all the way back up, all the way back down to the bottom of the trading range, back up again. Got down 3/4 of the way down, back up to the top of the trading range. Okay, I would be looking here if I could get a share price down at 280 down to 260. For me, that would be a perfect place to pick up some Amazon. Obviously, that would also be crossing here with the 200 weekly moving average. Point to make here with Amazon, with Netflix, shall I say? Sorry, beg your pardon, not Amazon. Is that, as I said, 2 years in the making, this trading range has been coming. Okay, so this is a compressed level within the market. Okay, I did speak a little bit about this sort of structure of the market where share price gets compressed. Okay, and it builds up energy like a cold spring wanting to release itself. Okay, and when it does release, that can be to the upside or the downside. Okay, but obviously looking at this formation and obviously fundamentally what we know about Netflix in its current situation, that would certainly mean upside potential here in the stock. Now, let me just open up here. Okay, we had a very similar situation back in 2015. Okay, as you see here, look, we traded in this box here. Let me just draw that box for you there. Okay, so this is the trading range it had. This is the trading range it had then, July 2015, and started to break out in December 2016. So that was like that was a year and a half in the making. Okay, so a little bit shorter than what we've got with our trading range at the moment. Okay, but once it broke out, you can see here it then found new common ground. Okay, so breaking out of that trading range, okay, it went from the top, which was at 128, and moved all the way up to its new highs, which was all the way up at all the way up here at 420. Okay, same sort of formations happening here. Okay, a lot of compressions happening here with Netflix. Okay, if we could get down, as I said, I'd be looking 280 to 260 would be a good place if we can get down there to buy Netflix. Okay, now if we were to break out of this box, this trading range here that it's been stuck in for the last 2 years, I would then project for the market, okay, to move all the way back up. Its next handle, okay, that I would expect would be up towards the 580, 570 level, okay, and that could take about, a year and a half to get up to, okay, once it actually breaks out of that trading range. So from where we are at the moment, even if we bought it today at 365, I would still project that we would be up to 580, okay, in the next I would expect the next 18 months or so, 24 months. So huge potential there with Netflix. As I say, I would be looking for a nice buy, okay, between the 280 and the 260 level. Okay, that's where I would be. That would be my opinion on picking up Netflix. Next is Google. We are, as you may remember, we are talking about at the moment that it's in a bear flag, okay, which is obviously negative for any sort of stock or charting or any sort of security that has this formation, okay. And as we see today, we are right at the bottom of this flag, okay. If we see the share price fall out of this flag, okay, then we are expecting to see further downside, okay, come emerge. Now, I would be, if I actually saw Google or Alphabet, okay, down at the 1K mark to the 900 mark, okay, for me, that would be a good place to pick up Google or Alphabet for the long term, okay. From there, let me just move this back to the weekly. For me, that would be a flush, okay, right below lows that we haven't seen since. There's been a level, so that would mean it will flush through lows that we have. So pretty much since October 17, okay, that would mean that would flush below those lows, okay. So it would mean that us picking up at that level potentially could mean that we'd be looking at levels that we haven't seen since the summer 2017. For me, that would be an opportunity to flush out all stops that are sitting below here, okay, to give an opportunity then to rally all the way back up. And then I would obviously be looking at the highs at 1500 and more, okay. But that would be my first point of call, be looking at target at 1500. But as I say, if I got down to 1000 to 900, that will be the place where I would be interested in buying Google for the long term. Now, some others that maybe not as headline as, say, Amazon, Google, and Facebook. Okay. Next one is a company called Tandem Diabetes Care. Okay. One that I have liked for a while here. Okay, and has got some great charting formations. Okay, that appears and works with this stock. Okay. So back in November 2016, okay, we had the start of this rounded bottom formation, okay, which is a good indication of, again, energy building, okay, getting ready for the next move. And as you see here, it builds out this energy by forming this sort of rounded bottom, okay? And once it actually comes to the top, okay, and we find a breakout, we find the breakout to be quite aggressive, okay? Which is what we saw here, okay? So it went from 23 all the way up to 50, okay? So it doubled. It doubled in a space from July to September, so it doubled in a space of a couple of months, okay? It then traded within a bull flag here, okay, as we see here, and then again broke to the upside, okay, to then trade in a new trading range, a little bit like when we was talking about Netflix, okay, trading within that range, compressing the share price, getting that cold spring ready for the next move, okay. And what we saw it break out of that trading range, but then failed, come back down, retake a new low, come off the 200 weekly moving average, and now we're back in the midpoint of that trading range, okay? And for me, that could be an indication now that we've taken out these new lows here, okay, and stops have been taken out. This could be the potential now for this to move up to a 120 target, okay? So we're trading at 62.5 at the moment. This potentially could be a double, okay? So I would, I would be happy buying around this level here for Tandem Diabetes, okay, looking for a target of 120, okay, and as I say, we're at 62.5 at the moment. Some great charting formations that appear with this stock, okay, does behave itself, and if it is suitable for you, this could be a good one to pick up for a long-term hold. Next is a company called Roku, okay. Again, this is one that that will benefit from the COVID-19 situation. Roku typically do supporting platforms from a number of technology companies. One of them is Netflix. Okay, so Netflix platform is supported and delivered by Roku. So we are looking at Roku as a company that will benefit from the new economy that we're going to see as we come out of the other end of COVID-19 here. Okay, so we have seen some brilliant strength off of Roku throughout 2019, as you can see here. Lovely strength that's come out of the stock, but has actually failed quite dramatically up at 120. Okay, until we got down to the low at 58. So pretty much halved. Okay, in just a couple of weeks. Now, with this, if we got a share price back down towards those lows, so I would say anything from like back down to those lows at say 50.5 down towards $47 per share, I think that's be a great place to pick up Roku. And then I would be looking at just as a near-term target back up to the level that the share price broke away from, up at 120. Okay, so this could be another 2 times return for long-term investors that potentially have the risk appetite to pick up this stock. But as I say, yeah, I would be looking at picking up this stock if we can get back down to the lows again, down at 58, 57s, down as low as, I don't know, 46, looking for a target back up to 120 at least. Okay. But as I say, this is a company that's going to merge out of the other side of COVID-19 with a lot of opportunity as more and more companies will start to look at companies like Roku to use them for their platform services. Next is Starbucks. Again, another company I love very much for long-term holds. Okay, let's just have a look here. Okay, let's pull this back. This again is the weekly. Okay, how does Starbucks react? Well, obviously supports the 200 weekly moving average, respects that a lot. Okay, but one of the key things here is this trading range here. Okay, so this started in April 2015 and it finally broke away in January 2019. So nearly 4 years in the making here. This trading range, come up to the top, couldn't break through it, come down the midpoint, back out at the top, come back down to the midpoint, back down to the bottom, out the top, and then broke away. Okay, so as it was at the top, it was at 63s, and then it went all the way up to what, 90, 99. Okay, since then it's obviously come all the way back down. Okay, and following COVID-19 situations, broken back below the 200 weekly moving average here. Okay, again, I would be looking again for another flush down below these lows. Okay, for a reversal all the way back up. I think that would be a fantastic opportunity for clients that are looking for buying a company on the long term. Okay, Starbucks, I would be looking, if we got the 50 down to 42.5, I think that would be a good place to pick up Starbucks. Great company, and will do well once we get through this COVID-19 situation, and from there, obviously looking for a reversal all the way back up to at least test the highs of 100. But this for me is a company that will, and as you can see how far this company's been growing. You know, the trajectory, and this is on the weekly. Okay, you know, it's just been since the financial crash. Okay, it's a stock that's been moving to the upside. Okay, so it's always good to pick up stocks that have a bullish sentiment about them. And as I say, Starbucks is one that I would be very much looking to pick up. A company that you might not have heard of, okay, is a company called Advantage Auto Parts. Now, these guys are a bit like Halfords in the UK, okay, but in America. Now, the theory behind this is if you can't fly and you want to travel, especially around America, okay, then you've got to drive, okay? And if you can't afford a new car, as you may not do after all of this, okay, because there's other bills and commitments that you have to deal with, okay, then you've got to fix the one you currently have, i.e. the current car you have. And with that in mind, then you're going to go to companies like Advanced Auto Parts, okay, to supply those goods for you. So we are at the moment trading off of a low that we had back in October 2017. Okay, so a nice level of support within the market itself. I would be actually looking to if we actually saw the share price come back down and test those lows again, okay, down towards those lows, so roughly near where we are at the moment, okay. So from anything, I would say anything from 80 down to 70, okay, I think that would be a great place to pick up this particular stock, okay. I think Advanced Auto Parts would be a great pickup there. Value is all the way back up at 160. So where the stock is valued, i.e., its proper valuation of the stock is all the way up at 160. So huge potential for growth within this stock. Okay, as I say, I would be looking to pick this up near where we are here. Okay, 80 down to 70 with a view to at least get to back up to 160, and that's Advanced Auto Parts Incorporative. Next is a company you probably have heard of, and that's Microsoft. Okay, we're on the we're again on the weekly. Okay, so what's going on with Microsoft? Let's have a look. Okay, so I drew here a trading range from July 2018 through to January 2019. So 6 months in the making, okay? Built up enough energy and blew out of that, okay? It's now basically moved into another trading range, which it started to form back in June 2019, okay? And is very much building energy again for another move, okay? Now, subsequently, we've come all the way down to the bottom of this trading range. Now, what I'd be looking for is actually a move back below this trading range briefly, okay, before reversal back up. Now, if we could actually see Microsoft down at 130 to 120, I think that would be a good place to pick up Microsoft for the long term, okay. What we expect to find after that, okay, is that this is quite a big move, okay, from up here, up at where we're like close to 190 down to the lows at 130, and if we did get our price down at 130 to 120, okay, that's a big move to the downside. Okay, so typically when you find the market make these big moves, okay, it's basically telling you it wants to trade within that range for a decent period of time. Okay, so I don't expect after we pick up here at 120 down to beg your pardon, 130 down to 120, that will go straight all the way back up. No, what I would expect is that the bias would be to the upside, okay, but will gyrate all the way back up towards the top, okay. So there will be ups and downs all the way back up to the top, and I would expect for that to basically build up for at least 12 months before having enough energy. Remember again about this cold spring, okay, for it then to break out of this trading range to then go and hunt for a new range it wants to trade in. Okay, so 130 to 120 would be where I would be picking up Microsoft. Next on the list is Becton Dixon. Now they do medical supplies and medical devices. Okay, as I've put down here. So this is one that's actually will be useful for the current situation that we're with at the moment with COVID-19. We're on the weekly again. We have seen the stock price move straight onto the 200 weekly average, okay, and is actually having some support there, okay, crossed with also a level of support in the market where we are at the moment, which is at 225, okay, we're trading at 228. Now, if we could actually see a break back down to test these lows, so I would say anything from 210 to 200 or 195. Let's call it, 210 to 195. Okay, I think that would be a good area to pick up Becton Dixon. Okay, and then from there, I'll be looking to basically test back up to the highs. Obviously, they're producing medical supplies and medical equipment. Okay, so that's something that you would expect to be in demand at the moment. Okay, so a company that that could be held on the long term. Okay, in support of the demand that it would have for its products with the current situation that we are in. Another one, American company, Home Depot, a bit like B&Q in the UK. Okay, this depends on state to state at the moment with regards to if you're allowed to go out and about. Okay, but a lot of states are still open, and you can go to companies like shops like Home Depot and get all the stuff you need to do to sort your house out and stuff like that. You've got a lot of time in your hands, right? So why wouldn't you? So because of that situation, Home Depot should be in line to actually benefit from the situation. Now, interesting note here. Okay, we're back on the weekly. January 2018, we have a high here, and then we've got October 2019, we'll have another high, and then February 2020 this year, we have this high. Okay, so we've got an expansive range at the top here. Okay, we've also got expansive range at the bottom. So we've got lows here in April 2018, lows here in December 2018, and then we've got the lows obviously we had back last week. Okay. So we've got this nice expansive range happening within the market. And of course, at the moment, we're just trading just over the 200 weekly moving average. Now, if we could actually get this share price back down towards these lows again, okay, back onto this level of support, okay, I would be start to look at picking up Home Depot between 160 down to the level of support, say at 145, okay. That would be, for me, a good place to pick up Home Depot. And then after that, I'll be looking to at least bring it back up to test the highs. But in consideration that we've got this expansive range happening, then really the likely target would be if we actually drew this line right out. And of course, it all depends exactly how long it takes us to get back up to this top of this resistance line. But I would have thought that would actually still be in place. So even if we if we take a year from today, we could be looking back up towards, say, 266 on Home Depot. So good one to hold, I think, for the long term. Everyone always needs equipment to do their houses up and stuff, especially when they've got nothing else to do. Next on the list is a company called Intuitive Surgical Incorporative. Okay, what do these guys do? Well, interesting one with these. Okay, so they got a system. Okay, it's called the Da Vinci Surgical System. Okay, basically it translates a surgeon's hand movements, okay, which are performed on instrument controls at a console, into corresponding micro movements of instruments positioned inside the patient through incision or ports. Okay, so they can actually be they can do this remotely. That's the theory, or at least in the next room. And obviously, with the situation at the moment, when you've got the virus that's going around, protecting frontline workers, okay, is imperative. And this obviously will keep patients separate from surgical doctors, okay. So a very interesting piece of equipment here, okay. And again, if we look at the chart here, okay, we've got a very similar situation that we just saw with Home Depot. This expansive range that's developing here. Looks very, very similar to Home Depot here. Okay, where would I actually pick this up on the long term? I mean, that this sort of equipment is going to be in demand at the moment. Okay, if we actually got it back down onto the 200 weekly moving average, so say down the 417, 415 level, that could be a good place to pick up Intuitive Surgical Incorporative for a long-term hold. I've got a 2.5-year target on this, okay, up at 900, and we're trading at 460 at the moment. So, double where we are at the moment in the next 2.5 years. Okay, so one there for the long term there, 2.5-year hold. Another is in an industry that's been hit hard, and that's the restaurant industry. And this particular company is called Shake Shack. This I put on here as an opportunity to look at a company that has potentially be completely oversold here. Okay, so we was at the highs in September, up at 104, and we're now trading down at 31.5. Okay, if you was to buy it here and we went back up to these highs, then you'd be looking at over 3 times your money back. Okay, so there's a lot to be interested here. Now the problem is obviously that all restaurants have been hit hard. Okay, why wouldn't they be? No one can really get to the restaurants. Okay, you're not getting the footfall through the door. Okay, and I suppose then you are very reliant on takeaways. But interesting point here is that we are on a very, very long-term support level here at 31.5. For people that may be looking at building a portfolio, or just look at this and think, you know what, I quite fancy buying a distressed stock. And Shake Shack is obviously, the share price is suggesting it's distressed. But I can say one thing: once it's all done and dusted, Shake Shack will be one to open its doors, and there'll be a lot of people want to dive in to actually get their burgers. I've had a couple myself, really nice, especially the milkshake. So 31.5 is a potentially good area to pick up some positions here with Shake Shack. As I say, long-term support, and if you actually look for this to get back all the way back up to the highs that we saw only in September, then you'd be looking at 3 times return of your investment there with that's Shake Shack. Next is Winnebago Industries. Okay, so in America, these are obviously massive, huge mobile homes, large caravans on wheels. Basically, you probably seen them all. Okay, but there's an interesting point here. Okay, and that is, and I spoke about this when I was talking about advanced auto parts. Okay, so you've got you potentially for the next 12 months got an inability to actually travel around. And I'm going to use America here because obviously, well, a lot of these Winnebago sales are going to be in the United States. So if you're unable to actually go from state to state via plane, you can't really fly by plane because you've got that 2-meter rule, okay, in place, and then everyone's worried about getting coronavirus and etc. etc. Let's face it, that's going to be like that for the next 12 months. If you want to go on holiday, you got a couple of options, okay, and one of the options is obviously to buy yourself a Winnebago, okay, and then travel around the country, not having to go into hotels or anything. You've got your own environment that you can protect from any potential diseases like coronavirus. Okay, so there is a strong point to getting a Winnebago and it making sense. Okay, so from that point of view, I think sales could be quite good. Now let's have a look at the chart, because what we've got here, blue box, we got a trading range here, okay, which started in December 2017 at the top. So we've had 2 attacks at the top, okay, and both times it's failed, and we've got 2 attacks at the bottom, okay, and on the previous time it actually supported the market. Okay, if we actually got this back down towards that level of support, okay, another retest, so back down, so to 25 to 20, okay, I think that could be a good place to pick up Winnebago. I would be looking even, and after we've seen that bounce, my minimum target on this will be back up to the midpoint of this trading range that it's been in, as I said, since December 2017, and that will be up to the 40 level. Okay, so if you actually got a price down towards the 20 level, that could potentially double your money. Over, I'd be looking for that to increase over the next within under a year. Okay, I think that's a very good target to have, at least back up to the mid range. Okay, which is where naturally the market will want to be pulling itself back to test the mid range. Okay, we see it with the Bollinger Bands all the time. Okay, it goes up to the top of the range and then always needs to come back down, retest before going back up to the top. So, for instance, you could look to buy down here, say between 25 and 20, hold your entire position up to the midpoint, okay? At which point you can then sell your entire liability, okay? So half of your position you could sell, which means then even if Winnebago went to zero, you would lose nothing because obviously you've sold your entire liability. So yeah, for me that's a good one for the long term. Winnebago there, okay? And that is about it of the longs that I've got for you that I found of any interest. So, okay, right. Let's just have a couple of questions here. Ibrahim said, "Would you typically wait for reversal confirmation before you buy a stock? For example, color rated in the index, company valuation, and Sigma events like COVID sent to everybody. Would you typically wait for reversal confirmation before buying a stock? Would I? If I'm if I'm looking for a place to put a strong long-term hold position, like I've said before, if you're actually buying a level where it flushes down. So, for example, this is probably not the best example to use. I have used better examples further back. So, for instance, if we look at Roku here, okay. So back here, let's move it to the daily. So typically here, what I'm looking for is the general market anyway that I'm expecting to see further downside anyway with. Okay, so that means that I'm expecting to see pressure across all of its stocks anyway. But for me to look for the ultimate buying level, okay, with this, okay, we've obviously seen a strong flash down within the market itself, okay, and obviously a reversal back. So at the moment, this bottom here is a reasonably strong bottom, okay. The strength of this bottom obviously increases if we've moved further and further away from this bottom. But as we see, we're coming back down. What I'd like to see here, okay, and this is my confirmation would be to get a flush below this level, okay, take these stops out, and then for a reversal way back up. If we got that, that would be a very strong bottom for me, and that would then give me the confidence to actually hold this stock for a longer term. You can look for, and on particularly with Roku, if we look at the weekly, you can look at rejection levels. So if this, as we see here, I mean, if I got that on a daily, then I would say that's a very strong bottom. Okay, very strong rejection level there on the weekly. Okay, and subsequently, it has made some movement away from that weekly level. So you can look at it in a couple of ways. Okay, you can obviously look for rejection levels like this. Okay. Or you can look for flush down below recent lows. Okay, so with regards to Roku, I'm looking for a flush down below recent lows for a movement back up to the level that it crashed away from. So I wonder that did that answer your question, Ibrahim? I mean, for people that are looking at shorts at the moment, okay, there's a number of different shorts that you can actually look at within the market, but these are all basically built up with sectors. Okay, so for instance, the airline companies. Okay, I mean, just So BA, for instance, we need to actually move this to a daily. You take your pick, whatever airline you want to look at. They all, it's like shooting fish in a barrel. You've got this sort of really half-hearted attempt to actually get a rally. As you got close to the midpoint, the 18-day moving average, this looks like this is going for another run down. You can take your pick. All the airline companies will look the same as this chart here. Okay, not much going for them at all. You got the travel sector, so you got Carnival Cruises. I mean, I don't really know what these guys are going to be doing because at the end of the day, they've got all their ships just stuck in port, nowhere to go. It's going to obviously take a long time to flush through the opinion of, virus spreading across a ship. How long is it going to take for someone to actually go, do you know what, I fancy going on holiday now. Now I've got to know if it's coronavirus, where am I going to go? Am I going to go in a contained area where if the virus spread, I would definitely get it, or be out and about? So I think cruise companies are going to feel the pinch for a while to come. I don't think there's going to be a massive recovery with these guys. Again, take your pick with any of these companies. I mean, just looking at this is on the daily, coming back down, testing the lows from last week. This looks like it wants to go for another run to the downside. Take your pick with the with regards to the travel companies. What else have we got? Hotels, same sort of thing. Not looking too good there at all. Again, I'd be looking to short those. Restaurants as well. Any of the restaurant companies, I'd be looking to short those. However, if you're basically restaurant companies, I would be looking to stay right away from the whole sector. However, if there is a particular company within that sector you want to have a look at, then it would be actually someone like Domino's Pizza, which in fact is probably like a technology company in itself in terms of its app and how it delivers, and the whole process of you ordering your food through an app. Okay, so for me, that's not the same. They will do. It should do. They shouldn't get that hard. Everyone's going to be hit by this coronavirus, but I think they're going to have more of a limited effect, with the coronavirus, just on the ability that how easy it is to order your pizza. You go on the app, you choose what you want, they actually come to your door, they ring your doorbell, they stand 2 meters back, you just take your pizza in. There's no problems here, If we have a look at the weekly with this, as we can see here, it's been reasonably strong, We're at above the top half of the Bollinger Band here. Is in a nice upward trajectory. This would be the company that I'd be looking to buy if I was going to be buying a company in the food sector. Apart from also, if I wanted to have a punt, and I like the fact is that I think that Shake Shack's been oversold, then Shake Shack would be the other one, as we're at a level of support there. So those are the ones that I'd be they're the ones I'd be be looking at. Abraham, what would you do there? So I mean, you obviously, it's obviously worth you looking at the general market, in terms of how that's been faring. Obviously the Nasdaq will give you an indication of obviously the technology companies, and that will give you an indication of exactly where the general market will be going. But obviously the individual stocks will have their own individual benefits and disadvantages. So with if I'm picking up any of the FANG stocks, then obviously NASDAQ will be something I'll look at first before I'll be looking to see necessarily if I want to pick up any of the FANG stocks itself. The correlation between, I think the question was the correlation between the indice and the stocks itself. That also depends on the weighting of that stock within the index itself, okay, which would give you that an idea on the correlation between the two. But with technology companies, very easy to go in the NASDAQ, considering most of it is made up of tech companies, okay. So that's what I'll be looking at. With the S&P 500, there's a lot more varied, okay. There's a lot of different sectors within that, okay, but it will give you, the S&P 500 will give you more of a broader view exactly what the general market is doing, okay. Whereas if you're looking at NASDAQ is very specific with technology companies and how they're doing. And then you also got the other, the Dow Jones, okay. Would give you a better idea if you was looking at, say, like a company like Apple or Boeing, okay, looking at how probably not Boeing at the moment, to be honest with you, bad example, but something like Apple, okay, that would give you an indication exactly where the market's heading. Apple's one of the biggest components within the Dow Jones, and also with, like, if you have a look at the Dow Jones Transportation Index, give you a very good idea of all the transportation companies like FedEx, for example. Okay, so yes, there is correlation, but also you need to have a look at what that stock that you are interested in, how that is weighted within the index that you're potentially looking at. Okay, thank you, Ibrahim. So I'm glad that was useful for you. As I say, it's we're at a there's good opportunities here for people that are looking at long-term portfolios. Okay, there is a couple of so the big opportunities that I remember, 1982 was one where where there was good opportunities to pick up stocks in the long term. 82, 87. 82, 87, 2000, 82, 87, 2008, and potentially now. They were the best times to really pick up stocks. If you picked up companies after the financial crash of 2008, 2009, and you're still holding those positions now, okay, the chances are that you would be in significant profit. Okay, we're seeing something very similar setting up here. Okay, we've seen some massive selling going on. Okay, we've got a new economy that's going to emerge out of this. It's going to be a very tech-focused economy. We're basically at the moment being forced to actually change the way that we live. Okay, because we're forced indoors, so that means we've got to adapt to that. So there's going to be a new economy that's going to emerge from this. So it's important to obviously look at stocks that you would expect to do well coming out the back of Corona, and hopefully I've highlighted some here, okay, that I feel are good long-term holds coming out of the coronavirus. So anyway, I'll leave that with you, okay. And we've got the general financial webinar, okay, it will be on Monday, where we'll have a look at the general market, see how that's been doing over the weekend. We'll get this posted anyway to the website for you to have a look at if there's anything that you need to go back over. But until then, obviously, have a lovely weekend, and I'll catch up with you guys on Monday. Take care now. Bye-bye.